Hey everyone, it's Rob B here with Rob D, and you are listening to the Property Podcast Market Update. Of course, we're going to be talking about property prices, lots in the news there, and the mortgage market has to be the big one. Products are being pulled, people don't know what to do. Not only do we tell you what's happening, we give you advice on how you should approach the mortgage market right now.
Welcome to the Property Podcast, which I think really thrives at times like this when there's so much uncertainty and there's so much going on, because we do this full time. We spend all our weeks running pretty decently sized businesses in property, making investments for ourselves and our clients, so we have a front row seat for what's going on. We benefit from conversations and insights that the mainstream media just does not have access to, and this podcast is how we bring that to you for free. So let's get straight into it. Okay, market update time. And as is traditional, let's start with house prices, where the data is a bit confusing because Nationwide is reporting that last month house prices fell by 0.1%, which means we're now about 4.7% below the peak in house prices, which was last summer. But asking prices, according to Rightmove, are up. They're up 1.8%, which is far higher than the increase that you normally see at this time of year. So Rob, what's going on? It seems like wall-to-wall bad news everywhere you look, but seems like no one's told the property sellers.
Or the buyers, really, because it depends on what you class as bad news. So Nationwide is the most extreme, with falls of just over 4% for the last 12 months. The Halifax numbers will be out by the time this goes live. Unfortunately, the Halifax numbers hadn't been published for this episode, but their last report in April had property prices up by 0.1% over the last 12 months. So really quite a boring 12 months in property if you look at it that way. So depending on which index you use, it's either flat or down by 4%. But again, that's not exciting enough for the newspapers, so they have to do more with it, right? So to give an example, the most recent data from Nationwide, down by 0.1%, so basically flat, has some news outlets reporting it as a crash and the market's fallen dramatically, whereas actually The Guardian was a bit more rational this time around and had a headline that says UK property market lacks spring bounce, but a crash is unlikely. So it's nice to see The Guardian staying away from the sensationalism there. Rob, it seems like a crash is wanted by the media, not because they want to see people financially hurt, at least I don't think so, but more because that's more interesting to report on, either a boom or a crash. And it seems like we don't have either at the moment. And as we come to the halfway point in the year, it appears that property crash that so many people were predicting is at this point looking unlikely. Unless something dramatically changes, an event occurs, it doesn't look like a property crash is going to happen. Is it a great year for property prices? No, of course it isn't. It's not that either. But at the beginning of the year, you thought the apocalypse was coming, and that clearly hasn't happened.
No, it hasn't so far. But what set off the latest wave of doom is what's happened recently in the last couple of weeks with mortgages, which we'll come to in a moment because that is a big topic. But while everyone's putting out their numbers around house prices, Zoopla have released theirs, and this did come out after all the recent mortgage changes, so it takes that into account. They believe that prices are going to be flat for the rest of the year. That's their prediction based on what they're currently seeing. And the latest report, to me, paints a picture of a market where people are just hanging out. The transactions are down, mortgage approvals are down, but price cuts are also down. So the percentage of listings where the price has been cut by more than 5% since being listed was 28% in February and is 18% today. So you wouldn't quite call it a standoff, but because the economy is strong, unemployment is low, there's not much in the way of forced selling. Even though mortgage rates have gone up, everyone's been stress tested against higher rates, so people might not like their mortgage payments going up, but it's not pushing them over the edge. What we appear to be seeing is what you often see in markets like this, where prices are what they call sticky downwards. In other words, people are not willing to accept a penny less than they thought they could get for their property at one point. So if they don't need to sell, they just won't. So that's where we are now. What is going to happen over the rest of the year? Well, I'm with Zoopla, probably not a lot. And when we're talking about house prices, I think what's really important to keep in mind is that these little moves, like, oh, is it going to be up by 0.5% or down by 1% or whatever it is, it just doesn't matter. Over the long term, it makes no difference. It would be insane to be making a buying or selling decision about an investment asset based on a couple of percentage points move that you think might happen over the next 12 months. What matters is, are house prices about to absolutely fall off a cliff? And for me, Rob, I'm just not seeing that. What we're seeing at the moment, it's important to bear in mind, is a very significant real terms fall. So if house prices are nominally flat or ticking down a little bit, but inflation is raging, property prices are falling in real terms. mortgages notwithstanding, they're becoming more affordable. And this is not something that we saw in the 70s when inflation was high. When you had high inflation in the 70s, property prices grew by just as much and then some. Now, when we've got high inflation, property prices are not doing that. So for me, the argument of, oh, well, property prices are so expensive, there has to be a crash, doesn't quite hold up, because if they continue nominally kind of going sideways for another 6 months, 12 months, whatever it is, then actually you kind of had this invisible correction.
You have. And while that may sound a little scary, oh, well, my asset prices are going down in real terms, you have to remember that our debt is also being devalued as well. Something we talk about frequently on the podcast is the power of leverage. And that is because if inflation erodes the value of your debt over the long term, well, at the moment, it's rapidly being eroded. So if you're using mortgages for your property purchases, then you are winning right now because those debts are being eroded, which is absolutely brilliant. And that's something that won't be talked about at all, really. So that's a real positive. But the most important lesson from this is what Rob's already said, but I just really want to highlight it, is 1 year doesn't make a difference to your investment. So whether it's up a bit, down a bit, or flat, when you look at this year, historically, in 10 years' time, it's going to look like a bit of a nothing year. Unless something dramatically happens in the second half of this year, it's a pretty mundane year. It's hard for the papers to write sensational stuff. What's happening with house prices isn't actually that exciting. It's scaring some people, but what is actually happening in reality isn't that negative. And when you look at it over the long term, it's even less spectacular than it is right now. So if you focus on the long term as a property investor, which is what we always say you should be, 1 year doesn't really make a difference. 1 year of modest growth or modest falls ain't going to change a lot. It's having multiple years of more growth than not, which is what you get. But Rob, before we move on to mortgages, which I know a lot of people want to hear about because there's so much happening right now, just want to highlight some of the news stories that have been circulating off the back of an economist from the OBR, David Miles, saying house prices could be much weaker moving forward because of people working from home and the fact that cities are no longer as desirable as they once were. That's interesting to me, Rob. I've not looked at the story as much as you have, but my immediate thoughts were, well, that's really conflicting from what we're seeing because the rental demand in the cities he's talking about is red hot right now. You can't get enough property because people want to live there. And most cities in the UK are actually doing quite well, with a few exceptions, and one of them being London. So yes, if this report was solely on London, maybe you could put an argument together there. I would still argue for many reasons it's not correct. But the data today is showing us that there's real strong demand to live in cities right now, and that most cities are actually performing quite well.
Yeah, I don't quite buy this. I don't really see what he's getting at, because he's saying that working from home means that we're not going to continue to have the explosive, his words, property price growth of the last 40 years. But to me, that only makes sense if suddenly everyone becomes completely agnostic about where they live and decides to spread out pretty much equally across the entire country, which is just not going to happen. Because even if people aren't clustered in cities, which I think they will be, you'll still surely be clustered around transport links into those cities, because most people will be going in occasionally, even if only because they want to, because cities are great places. So I don't really get that. But he's also said that a reason for having less explosive house price growth in the future is the end of this trend of declining mortgage rates that was in place for decades. And that I agree with. Whatever happens to mortgage rates from here, and we'll come to that, it's clear that this relentless declining trend ending up at zero is over. That's just not happening. And that gave a tailwind to all asset prices. And to me, at least, that's no bad thing. You can't have property prices that race ahead of incomes every single year, because you get to a point where they're unaffordable. You have to do mad things to try and make them affordable. Eventually, it doesn't work and it all comes crashing down. Not a good thing. Whereas if you have just moderate growth, plus juice up with a little bit of leverage, you end up doing really well as an investment without all the drama. So I suppose I'm saying I agree with his conclusion, but not the analysis. And if it is the case that house prices aren't going to be insane in the future, then I don't think that's something we should be mourning.
No, but finally, a very quick one to end on with house prices is we often give you the data from Home Track. And the top 5 cities at the moment, well, how are they performing? Well, Bournemouth is at 9%. Leeds, 4 at 9.1%. Birmingham, 3rd at 9.2%. Second, Manchester at 9.3%, and Nottingham leading the way at 10.9%. Those numbers do not suggest to me that people are having a mass exodus from cities. In fact, quite the opposite. You could argue there's a quiet property boom that's occurred in cities over the last 12 months that people just haven't been talking about. As a wider UK, and when we consider all the suburbs and all the areas, yes, property prices are down a little or flat, depending on which data source you take. But cities over the last 12 months have quietly done very, very well. And that is something that you probably wouldn't hear anywhere else, but we like to dig into all the stories on the pod.
We're on a mission to open up the benefits of property investment to as many people as possible. And we're doing it with our mobile app, Portfolio. Portfolio provides what we believe is a completely new way to access the potential benefits of property investment, while feeling just as involved as if you owned a buy-to-let. You can find out more about investing through Portfolio at portfolio.co.uk.
Rob, it's time to dig into mortgages right now. There's loads going on in the world of mortgages, so much to get into. Obviously, interest rates have gone up since we last recorded the podcast. Widely expected, but they have gone up. But inflation, while fell, didn't fall in line with market expectations. And all this means that the mortgage market right now is a little all over the place because the mortgage lenders are really struggling to price their products. And it is starting to settle down, but that volatility is making people nervous, Rob. And while we've spent a little while talking about a property market that's basically done nothing over the last month, the mortgage market has been very busy.
Yeah, mortgages have been all over the news for the last couple of weeks. And it's because, like you said, of the latest inflation data, basically rattled everyone. Inflation not falling as fast as it should, therefore markets pricing in interest rates that are higher for longer. The market's now pricing in something like 2 to 3 more quarter point rises, so up to another 0.75% from here, with cuts to the base rate not happening until next year. As a result, swap rates, which are used for pricing fixed rate mortgages, are up by about 0.6%. And naturally, where they go, mortgage rates follow. So what we've seen over the last couple of weeks is more than 300 buy-to-let deals being pulled, because suddenly their cost of funding has gone up. Now, this isn't as dramatic as it first appears, because you always hear when lots of products get pulled at the same time, but you don't hear when they gradually get drip-fed back onto the market again. So this happened after the mini-budget, happened at a much greater scale, and it's now happening to a lesser extent again. And mortgage rates aren't anywhere near as high as they were after the mini-budget either. But what I think has rattled people is that it's going the wrong way. So the whole way through this year so far, we've seen the mortgage market stabilising, we've seen rates falling, and you've got this narrative of, okay, great, we had this kind of shock, everything's settling down, the base rate's probably about as high as it's going to go, that's going to start coming down, inflation's going to start coming down, everything's good. Then this has happened, it's like, oh, well, maybe it's not that simple. So I think, Rob, we should attempt to answer the question that we attempted to answer back in October, when a far more significant and scary version of the same phenomenon was going on, which is, what should you be doing right now?
Aha, well, Rob, that is the big question, isn't it? And I'd actually say the advice hasn't changed much since October, which back then we said that if you can do nothing, do nothing. Why would you enter the mortgage market right now if you had to, when there's a little bit more uncertainty and products are all over the place? But if you do need to take a mortgage out right now, which I'm in the process of doing, and Rob is as well, then you need to take a view. And your view has to be, what do I believe will happen with interest rates over the next few months and years? And the markets widely report that interest rates may go up a little over the next 12 months, but they're not expected to go up much more. So if you believe the experts to be true, then you can look at your numbers and go, okay, do I want to fix and know that I'm solid on this price for 2 or 5 years, and 5 years tend to be cheaper than the 2 years right now? Or do I want to gamble, which it kind of is in a way, if you take a view on a shorter term product and go, well, they may peak in the next 12 months, you might reasonably believe that it may start to fall in the coming years, and in 5 years' time, they'll actually end up lower than where you are right now. I think most people, based on that, will go for a 5-year fix, that certainty, and they generally are the best price products out there at the moment. So I think a lot of people will go down that route just for the peace of mind, and if your numbers work on the 5 years, then why not? Yes, rental profit is important and you must make a profit. But as we all know, the real wealth in property is made through capital growth over the long term. So you have to ask yourself, is it worth the risk, the gamble, to potentially make a little bit more cash flow a few years into your purchase versus the peace of mind of security of knowing where you're at for the next 5 years? The decision is ultimately yours, but hopefully that gives you a framework for helping you make a decision. But most importantly, if you're not buying a new property right now, sit and wait it out for a few months, let it settle down again. But if you're in the middle of taking out mortgages, then at least you've got a guide to how to approach it.
So mortgage is very much the topic of the day, but there's a whole lot of other stuff going on as well. What's not happening is any more movement with the Renters Reform Bill. You'll recall that we had the podcast about that had a really popular YouTube video about that and said, we'll keep you updated when something happens. Well, so far, nothing has happened. It was introduced to Parliament. The next stage is for it to have its second reading, which at the time of recording still hasn't happened. So there's been no opportunity for MPs to debate it. So we've got no indication of what might end up being amended. But of course, we will keep you updated on this podcast. And make sure you sign up for our newsletter, Property Pulse. Go to propertyhub.net/pulse. It's free and you get all the main news stories in your inbox every Friday morning.
Our next story comes from This Is Money, and the headline reads, Backlash grows over new energy efficiency rules for landlords. And yes, we've reported and talked about EPCs a lot on the podcast, particularly on Ask Rob and Rob. And that is from 2028, your property will need at least a C rating for it to be up to standard and for you to be able to let your property out. There are exceptions and there is a lot to it. And that's why we've got a big piece in the upcoming edition of the Property Hub magazine. If you are not a subscriber yet, if you are quick, you can get in. And even if you miss it, you'll still be able to access it as a back catalogue online. So go to propertyhub.net/magazine for all the info from our expert there. And for those wonderful and wise individuals who are already subscribers, make sure you check out that article. There's loads of good info in there.
And elsewhere, lots of political posturing going on at the moment around leasehold. So if you recall, and you might not, because let's face it, it's really boring and no one except us is probably following this stuff, the Conservative Party started out saying that they were going to reform leasehold, then that they were going to abolish leasehold, and they go, actually abolishing it sounds hard and we've got lots of stuff to do. So they decided they were just going to reform it after all, that they will abolish the leasehold system if and when they come to power. It's hard to know exactly what will happen and quite how historic leases will be dealt with, but I think this has now reached the status of being one of those things where there's enough political momentum around it that in 5 or 10 years' time, even if the term leasehold still exists, I don't think it will be anything like the form that we know it. And that is no bad thing, unless you happen to invest in freeholds. But of course, while some houses are leasehold, the majority of leasehold properties are flats. And one of our recent YouTube videos is about whether houses or flats make a better investment. And in that, we run through some common misconceptions that people have. So do go check out that video and all the other goodies on our YouTube channel. Just go to YouTube and search for Property Hub.
So it's time for Hub Extra, the part of the show where we like to give you that little bit more. And this week's Hub Extra is a really simple one. It's send to Kindle. So the Kindle is a great device, and Rob recently talked about it on Hub Extra. And it's great when you buy a book from Amazon and it's on your Kindle device in seconds. But what about all those other documents that you want to read and consume? Like a PDF, whether it's a long document or a book. You may want to read that from your Kindle. But how? Well, really simply, actually. You need the extension Send to Kindle. It's actually produced by Amazon. And you can do it in so many different ways. You can do it from your phone. You can do it from the web. You can do it from email even. The Chrome extension. All the different methods that you would want to use are available. Just search Send to Kindle. You can find a link at amazon.com/send to Kindle. And you can start sending all types of documents, emails, or whatever else you choose to your Kindle device. It's free to use, and I'm sure many of you who own Kindles would like to use it. So go check it out and enjoy. And remember, we like to bring you extra ourselves. On Friday, we have the Property Pulse email, which is written by Rob D himself. Sunday Times best-selling author, don't you know? And his email, I think, is a great extra that you need to take advantage of. So if you haven't signed up for Property Pulse, it's free. So why not go to propertyhub.net/pulse and get yourself signed up, and you will get a bit more extra in your inbox each and every week.
Yeah, free newsletter, free YouTube channel, free podcast, and all you have to do in return is sit through a very occasional advert for one of our services. What more do you want? You want us to do it all again next week? Well, fine, we will. We'll be back with the Property Podcast again next Thursday. It's going to be a good one, so we'll see you then. Have a great week. Bye-bye.
Bye.